The market is closed for the weekend, and SoFi Technologies Inc. closed its last active trading session on Friday, June 12, 2026, at 4 p.m. Eastern Time at exactly $16.58 per share, marking a small intraday slide of 0.54% on heavy volume of over 50 million shares moving across the desk, $16.23, before finding a bit of late afternoon support to wrap up the week. While a minor drop on a random Friday might seem like typical market noise, the deeper data reveals that the massive volume behind these moves points to institutional hands shifting capital beneath the surface, exposing a massive fracture between public sentiment and raw financial reality. The collective belief surrounding SoFi right now centers on the idea that it has finally graduated into a stable, highly profitable consumer banking powerhouse that can outpace traditional institutions by offering superior digital tools. Retail investors look at the consistent GAAP net income profitability over the last several quarters, including a massive record net revenue of $1.1 billion reported in their first quarter earnings, and assume the coast is clear for an aggressive upward march. This expectation builds a narrative where SoFi is a runaway freight train destined to dominate the digital banking space. The hidden reality, however, is that institutional market makers are treating the asset with immense caution, treating its premium valuation with skepticism because its rapid expansion has been heavily fueled by a surge in personal lending and high-yield deposit acquisition that carries real risk in a sticky inflationary environment. The massive daily volume swings we are observing suggest that the big money isn't just buying and holding blindly, they are trading the volatility, squeezing premiums out of retail optimism while resetting their risk metrics on every macro headline. When you track the recent institutional activity on the tape, you notice that large block trades have been clustering heavily around key technical pivot points. The trading session on June 11 saw a massive 5.04% surge to $16.67 on 68 million shares, only to follow a punishing down day on June 10 where the stock shed over 3.6% on 86 million shares. This frantic back-and-forth trading action tells us that institutional investors are using the liquid options market and major block transactions to hedge against broader economic data. This constant tension is exactly what makes the self-investing landscape so treacherous right now, as retail traders on popular platforms try to ride the momentum without realizing they are playing against high-frequency algorithms that thrive on these exact point-to-point daily fluctuations. The sector momentum for regional banks and financial technology firms has been mixed, putting additional pressure on SoFi to continually prove that its customer acquisition model can withstand higher for longer interest rates. If you watch our peer stocks behave, like the way a sudden swing in Tesla stock or Apple stock can alter overall retail market liquidity, it becomes obvious that SoFi is acting as a high-beta lightning rod for growth-oriented retail capital. Comment below how many shares of SoFi you currently hold in your portfolio and tell me if you are actively buying more at these levels. Looking at the macro picture, the broader consumer finance sector is facing headwinds as credit card delinquencies tick up across the country and the cost of capital remains stubbornly high. This environment changes how investors approach online investing because the easy growth phase of the market has passed, forcing market participants to rely on robust individual brokerage analytics rather than social media hype. When compared to legacy institutions, the digital platforms have to fight twice as hard to maintain user loyalty. For instance, major market players using sophisticated systems like Schwab Intelligent Portfolios or various institutional trading desks are constantly shifting their weight between traditional banking giants and these newer digital alternatives based entirely on net interest margin stability. This shifting landscape means if you are looking for investment help or trying to navigate self-investing options across top investing sites, understanding how institutional liquidity interacts with retail order flow is absolutely essential. To see the full picture of why the stock is behaving this way, we have to look at what this business actually is under the hood. SoFi Technologies operates as a comprehensive financial services platform that attempts to capture a consumer's entire financial footprint, providing everything from student loan refinancing and personal loans to checking accounts, mortgages, and wealth management services. Their core business model relies on a powerful cross-selling flywheel, where the company acquires a customer through a low-friction product, like a high-yield savings account or a basic investment account, and then uses that relationship to sell higher-margin products like personal lines of credit or mortgages later on. Over the past few years, this strategy has allowed them to rapidly grow their total member base well past the 8 million mark. In addition, their acquisition of the Galileo technology platform and Technisys gave them a unique business-to-business infrastructure arm, allowing them to process payments and provide banking-to-business services for other financial institutions around the globe. This diversified layout was intentionally built to assure they weren't just a cyclical lender, but a multifaceted infrastructure giant that could generate recurring high-margin software fee revenue alongside traditional banking interest. Historically, this business model was met with extreme skepticism, especially during the multi-year pause on federal student loan repayments, which completely completely froze what had previously been their most reliable and profitable customer acquisition channel. The market narrative back then was that the firm would burn through its capital reserves before reaching profitability, causing the share price to languish in the single digits for an extended period. However, the reality flipped dramatically when the company secured a national bank charter, allowing them to hold consumer deposits directly and use those low-cost deposits to fund their loans rather than relying on expensive warehouse lines of credit from external wholesale lenders. This single structural shift completely transformed their unit economics and allowed them to build a massive cash pile that finally pushed them into consistent GAAP profitability over the past year. Their first quarter financial report highlighted this transformation beautifully, showing net income climbing to $167 million and net profit margins hovering near 15%. This past performance proved that their infrastructure could scale efficiently under the right conditions, yet the market has already priced in much of that initial operational success, leaving the current stock price highly sensitive to the next wave of execution risks. Looking forward, the future outlook for the company is a classic battle between bullish growth projections and conservative risk management. In a best-case scenario, the digital bank continues to successfully cross-sell its premium services, and its technology platform begins to secure massive enterprise contracts with Tier 1 traditional banks looking to upgrade their core systems. This outcome would cause fee-based revenue to rocket higher, reducing the company's reliance on interest income and transforming the stock's valuation from a traditional bank multiple to a premium technology multiple. On the flip side, the bear case is deeply tied to the health of the macroeconomic consumer. If unemployment ticks higher, or if inflation keeps interest rates elevated to the point where personal loan defaults rise significantly, the company will be forced to increase its credit loss reserves, which would immediately eat into their hard-earned net income margins. Furthermore, competitive pressures are intensifying as major legacy brokerages roll out enhanced digital features and competitive yields to protect their deposit bases from being eaten away by digital upstarts. When you look at where the smart money is moving, you can see a massive divergence in how the platform is being handled across the online investing space. Sophisticated traders using an advanced interactive broker's platform or managing substantial asset bases through interactive broker stock trading systems are meticulously calculating the company's tangible book value and comparing its net interest margins against traditional consumer lenders. They notice that while the platform's user growth is stellar, the capital expenditures required to maintain their technological lead and market their services remain incredibly high. Meanwhile, everyday investors using a simpler Robinhood app or executing trades through automated Robinhood investments are often chasing the headline growth numbers without discounting the potential credit risks embedded in the loan book. This mismatch in sophisticated analysis versus retail enthusiasm is precisely what keeps the stock's beta exceptionally high, causing wild swings whenever a competitor adjusts their interest rates or an analyst changes their price target. Ultimately, navigating an environment like this requires looking past the glossy user interfaces and focusing entirely on the underlying asset quality and deposit stability. The modern digital banking space is no longer a wild west of unbridled user acquisition. It has matured into a strict battle for high-quality, sticky deposits that won't flee at the first sign of macro trouble. Whether an investor chooses to manage their capital via dedicated self-investing accounts, relies on comprehensive corporate offerings like Fidelity Wealth Management, or tracks individual assets through popular retail portals like the SoFi trading platform itself, the core metric that will dictate long-term equity value is the net return on equity. The market has established a clear line in the sand, and the companies that can consistently deliver solid bottom-line profits without overexposing themselves to risky consumer debt will be the ones that sustain their valuations when the macroeconomic tide turns. To wrap things up, the central takeaway from analyzing this digital banking pioneer is that while the public expectation points to a flawless, tech-driven expansion, the financial reality remains tethered to classical banking metrics and credit cycle risks. This tension between these two forces is exactly why the asset experiences such intense trading volume and sharp intraday price reversals. The company has undeniably proven its ability to pivot, secure a bank charter, and generate substantial net revenue, but the market is now demanding proof that its loan portfolio can withstand a prolonged economic slowdown without fracturing. For anyone watching the ticker, the key will be tracking institutional block data and credit provision metrics rather than just relying on top-line member growth headlines. The era of buying growth at any cost is over, and structural financial strength is what will separate the long-term winners from the short-term trading vehicles in this rapidly evolving market. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thanks. Don't forget to like, comment, and share this video to support the channel.